Thank you for joining me this Friday, the 1st of December. I'm Grady, market analyst at Bell Direct, and this is the weekly market update. As we head into the final month of 2023, it's time to look back at how the sectors on the ASX performed throughout the year that was and look ahead to the outlook for 2024. Where are the buy ratings, and are some companies overvalued in the current market environment? Inflation, interest rates, China's economic recovery and geopolitical tensions have really weighed on the sectors this year, some for the better and others for worse. Let's dive into how some of the key ASX sectors have performed in 2023. The technology sector has captured the attention of investors both locally and globally in 2023 after sharp sell-offs in 2022. The volatility since the COVID-19 rally for the high-growth sector has been a roller coaster of highs and lows that saw investors pile back into the tech sector this year, mostly driven by the hype around artificial intelligence. AI has been the term of 2023, given its hyper-efficiency nature of delivering operational excellence. However, investors need to be aware before backing a company based on saying they're investing in AI versus companies that are actually making material investments in AI. The sector is up 21.5% in 2023 on the ASX to lead the gains among the 11 sectors, with key names making waves this calendar year. While companies like Life360 have prevailed through the tech rally, with the shares in the location tracking company up 58% in CY23 as the company continues to prove cash flow positivity, others are facing slowing earnings outlook for FY24, including WiseTech Global. Investor appetite for high growth stocks has rebounded given the certainty around interest rate peaks. However, when it comes to investing in the tech sector, it's important to analyse the fundamentals behind the company and whether they have a profit on the horizon, a strategic growth outlook and material investment in AI. Consumer staple stocks have faced some headwinds in 2023, despite higher interest rates traditionally favouring companies in this sector, as higher costs can be passed on without impacting demand. Tailwinds we saw in 2022 have turned to headwinds in 2023 for some key names, which is what sparked investors to sell out this year, with the sector down 6.5% year to date. The supermarket giants have remained resilient as they have successfully passed on rising costs and managed debt well, while also rewarding investors with consistent dividends. But for other companies like Ingham's Group, feed cost inflation is hurting margins in the current macro environment, which has led to lower earnings outlook and the expectation of consumer demand for chicken to slide as alternative protein prices like beef and lamb decline. While this sector is down in 2023, staple names like Woolworths and Costa Group remain key staple investments within portfolios, as shares in these companies are up 5.5% and 13.5% respectively year to date. Discretionary stocks have surprised the market this year as investors and economists alike expected consumer spend in the discretionary space to ease, given the 13 interest rate hikes in Australia, placing increased pressure on all Australian hip pockets. However, this certainly hasn't been the case until October. Retail spend in Australia continued to grow, indicating Aussies kept spending despite the increased cost of living pressures. The discretionary sector is the second best performer year to date, up 11.66% over the 11 months to December 1. JB Hi-Fi is up 13.63% since January 1, 2023, as investors responded to key strategic moves made by the company, including a key focus on reducing inventory levels, restructuring the group's capital structure to maximise shareholder returns, and bolstering the company's cash position to weather the economic uncertainty. As retail spend has begun to slow as per October's retail sales data from the ABS, we may expect a slight pullback in this sector heading into the new year. The financial sector has dipped into the red later this year as investors assess increased competition as customers switching between the big banks to get the best rate on offer for both deposits and loans is on the rise, and net interest margins peaked during FY23 for the big four banks. Energy stocks have also been the worst performing sector in 2023, primarily due to fluctuations in the price of oil and and geopolitical tensions weighing on the key commodity outlooks. The price of oil has been heavily impacted this year by China's weaker than expected recovery post-pandemic and key oil-producing nations announcing output cuts to boost the price of the commodity amid escalating geopolitical tensions, especially in the Middle East. Over the year, the price of oil is down 3.4%, which has weighed on companies including Woodside Energy, Santos and Beach Energy, as each of these oil producers' shares are down in 2023. Overall, the outlook for healthcare stocks is positive heading into 2024 as valuations of key companies have fallen throughout 2023. Despite strong earnings growth potential, key catalysts heading into the new year for some big names including Telix Pharmaceuticals and the prospect of rate cuts on the horizon proving favourable for margin expansion. Locally from Monday to Thursday, the ASX 200 rose 0.66%, boosted by favourable inflation data in Australia, which fuelled a rally for the tech sector locally as it rose 3.42% over the 4 trading days. The winning stocks on the ASX 200 this week were led by Iress, jumping almost 20% after the company released a strategic update outlining its transformation program is progressing very well. Helios and Emerald Resources also rose 15.38% each from Monday to Thursday. On the broader index, the All Ords rose 0.74% over the trading week, led by Opthia rocketing over 31%, while Temple & Webster rose 31.18% after the online furniture retailer released a strong trading update at its AGM. Aeris Resources, EML Payments and Core Lithium weighed on the All Ords this week. The most traded stocks by Bell Direct clients this week were South32, CSL, Temple & Webster, Telstra, Wesfarmers, Woolworths, Treasury Wine Estates, Coles Group, Origin Holdings and GUD Holdings. And on the diversification front, the most traded ETFs by Bell Direct clients over the 4 trading days were led by Vanguard Australian Shares Index ETF, Beta Shares Australian High Interest Cash ETF and Van Eck Gold Miners ETF AUD. Looking at the week ahead, the all-important, highly anticipated RBA interest rate decision is announced on Tuesday, with the expectation of Australia's central bank to hold the cash rate at the current rate of 4.35% for the final month of 2023. Australia's GDP growth rate data is also out on Wednesday for Q3, with the expectation of a slight contraction to 0.3% growth for the quarter. And Australia's trade balance data is out on Thursday. Overseas, key US jobs data is out on Wednesday, with JOLTS job openings data for October, non-farm payrolls data and US unemployment rate data all released, which will give further insight into just how tight the US labour market remains. And that's all for this week. We hope you have a wonderful weekend and, as always, happy investing.